Okay, traders. Today we're going to be talking about retracements and also the long-term trend. So, at the moment, this is a monthly chart. We can see this. This is going back to 1998, and you can see the trend was very much to the upside here. And then, of course, we had the financial crash, which came in here. We had a big bear market, which moved all the way down here, and then of course we've just been moving up now. So long-term trend was certainly up here, then it was down, and now it's back up. And again, this could actually be turning. Certainly, if we start breaking sort of below 7,000, the trend will be turning down again. But for the purpose of this video, the trend is still to the upside to some degree. So when the trend is up, if you're using a breakout strategy, which we'll cover in a second, but just say we're using a breakout strategy, then once the breakout strategy is triggered, it does make sense to wait for a 50% retrace. So in this case, because the trend is to the upside here, if we take a breakout strategy to the downside, we should really wait for a 50% retrace to get a better entry, because generally most of the time if the trend is up and we get a signal to sell, you'll probably get a retrace once it's triggered, which will give you better risk reward. So let's just have a look at a 15-minute chart. So we just take a 15-minute chart breakout, and we can look at yesterday. It's not a problem. So we can see here. I mean, just say for example we are using this 15-minute bar here. We're taking a break of 2 pips. So the low of the bar is 51. So let's put that in. You're basically getting in at 49. So okay, so once it breaks, you're in down here. So you're in at 49 here, and you basically anchor it, because this is the lowest point. You anchor this here, and you take it to the top of the 15-minute chart. Top of the 15-minute bar here. This is the observation bar. Obviously, it didn't break to the upside; it broke to the downside. So just say, for example, once this breaks, you're then looking at a target. And again, this isn't a system. I'm talking about the principle of using a retracement. So once this 15-minute bar breaks down, you may have a target down at 73.20, for example. But instead of just waiting for a straight break to get in, wait for a retrace to get in to give you better risk reward, because then you can. The risk, if you can get the hit rate for your system up to 70, and you're getting 1-to-1 in your trades, you're risking 1 to make 1, then you have the license to make money. That's a recipe for making money right there. So for this example, if you're just trading your system and it tells you to get in on a break of the bar, so you're in at 49. In this system, in this principle, you would wait for it to be triggered down, but then wait for a 50% retrace from the lowest point, and in this case you'd be getting in at 57. So instead of getting at 49, you're getting at 57, which greatly increases your risk reward. Your risk will most likely be on a break of the bar up here, and the target would have to be defined by your system. And by doing this, your risk reward is greatly increased.